Every single day, the Hormuz crisis is costing the world around $1 billion. Not in one country, not in one industry, across the entire global economy at the same time. And the damage isn't slowing down, it's accelerating. Because what's happening in the Strait of Hormuz is no longer just a military conflict, it's a cascading system failure. On February 28, 2026, the United States and Israel launched coordinated airstrikes on Iran. Within hours, the situation in the Persian Gulf shifted. The Strait of Hormuz, one of the most critical shipping corridors on Earth, became effectively unusable. Not officially closed, but too dangerous to operate. And that distinction matters, because global trade doesn't need a formal shutdown to collapse. It just needs risk, uncertainty, and the perception that a route is no longer safe. Most people have been watching the military story: missiles, naval standoffs, diplomatic ultimatums. But underneath all of that, another crisis has been unfolding. Quieter, slower, but far more dangerous. Because this one affects everything. To understand the scale, you have to look at a map. The Strait of Hormuz connects the Persian Gulf to the open ocean. At its narrowest point, the shipping lanes are just a few kilometers wide in each direction, a tiny gap, but one that holds together a massive portion of the global economy. This is the only exit route for energy exports from Saudi Arabia, Iraq, Kuwait, Qatar, and the United Arab Emirates. Under normal conditions, more than 20 million barrels of oil pass through this corridor every single day. Around 20% of global LNG flows through it. Between 20 and 30% of the world's fertilizer exports depend on it. And nearly half of global seaborne sulfur trade moves through it, all through a passage barely wider than a city street. So when this route becomes unstable, the system doesn't slow down, it fractures. Please take a moment to subscribe and like the video. It really helps the channel. The first wave hit almost immediately. Energy markets reacted within hours. Brent crude surged past $120 per barrel. LNG spot prices in Asia jumped more than 140% after Iranian strikes damaged Qatar's Ras Laffan facility. Gas prices in the United States hit $4 per gallon, a 30% surge within weeks. The International Energy Agency called it the largest supply disruption in the history of the global oil market. But this wasn't just about prices. It was about access, because then came the real constraint: insurance, war risk premiums, which normally sit around 0.25% of a vessel's value, surged to as high as 10%. And they reset every 7 days. For a modern tanker worth over $100 million, that's millions of dollars per week, just to enter the region. For most ship owners, the decision became simple: don't sail. Within weeks, daily tanker passages fell from around 130 to just 6, a 95% collapse. Over 2,000 ships and 20,000 mariners became stranded inside the Persian Gulf, unable to leave because insurance companies had revoked their coverage. This was no longer a price spike, it was a supply shock. The second wave hit something far more fragile: food. Modern agriculture doesn't just rely on land and water. It relies on inputs, fertilizers, chemicals, supply chains that run on precise timing. A significant portion of those inputs moves through the Strait of Hormuz. When that flow was disrupted, urea prices rose 36% above pre-war levels. In the United States, some fertilizers jumped more than 40% in a single month. Natural gas, which determines 70 to 90% of the cost of producing nitrogen fertilizer, saw production drop 20%. Russia suspended exports of ammonium nitrate to protect domestic supplies. China blocked phosphate exports, removing 25% of global supply overnight. And the timing made it catastrophic. This disruption hit at the exact start of the Northern Hemisphere planting season. Corn Belt farmers in the United States needed fertilizer in March and April, precisely when supplies collapsed. The Food and Agriculture Organization has warned the window to prevent a full food crisis is rapidly closing. Their chief economist put it simply: the clock is ticking. The damage is not evenly distributed. Some countries are being destroyed in ways that will take years to recover from. Gulf states, which rely on the strait for over 80% of their caloric intake, face a humanitarian emergency. By mid-March, 70% of regional food imports were disrupted. Consumer prices spiked between 40 and 120%. Retailers were airlifting basic staples. Iranian strikes on desalination plants created a water emergency in Kuwait and Qatar, countries where desalination supplies virtually all drinking water. Japan relies on the Middle East for 90% of its crude oil. South Korea gets 70% of its crude from the region and has already activated a 100 trillion won stabilization program, roughly $68 billion, to manage the damage. The Philippines declared a national energy emergency on March 24th. Nepal began rationing cooking gas. In the United Kingdom, major supermarket chains warned of fuel shortages. In Africa and South Asia, regions with almost no financial buffer, governments are choosing between subsidizing fuel and funding public services. The IMF has been direct. Energy importers suffer more than exporters. Poor countries suffer more than rich ones. And those with limited reserves suffer most of all. The third wave is the one almost nobody is talking about because it doesn't look like a crisis. No queues, no empty shelves, no immediate signals. But the impact could be just as serious because this wave affects the future. The global economy is rapidly building infrastructure for artificial intelligence, data centers, power systems, communication networks. All of it depends on copper. Copper is essential for cables, transformers, and every part of modern electrical infrastructure. But copper production depends on sulfur. Sulfuric acid, made from that sulfur, is the only cost-effective way to extract copper from ore. The Strait of Hormuz facilitates roughly 50% of the world's seaborne sulfur trade. No sulfur means no scalable copper production. No copper means no new wiring for the infrastructure the AI economy depends on. At the same time, South Korea, a global leader in semiconductor production, sources nearly 90% of its bromine from this region. Bromine is critical for chip manufacturing. This is no longer just an energy crisis. It is a supply chain disruption that reaches into the future of technology itself. Here is what makes this crisis so dangerous. The $1 billion a day figure is not fixed. It compounds. Economists at the Dallas Federal Reserve have modeled what happens next. If the closure lasts 1 quarter, oil reaches $110 per barrel. 2 quarters, $132 per barrel. 3 quarters, $167 per barrel. At $167, the damage moves from crisis to catastrophe. Stagflation, recession risk, debt crises in developing economies already stretched to breaking point. And even after the strait reopens, the bill does not stop. Fertilizer that was not delivered in March cannot be retroactively planted. Crop yields across India, Brazil, and East Africa are already expected to be lower in 2026. Food prices, which respond to supply disruptions with a delay of months, are just beginning to reflect what happened in February and March. The FAO has explicitly warned that food price increases will persist well into 2027. Qatar's Ras Laffan LNG facility faces 3 to 5 years of full repair. The 1973 oil embargo lasted 5 months. The structural changes it triggered lasted decades. This crisis is already larger than 1973. We return to where we started, $1 billion a day. 54 days since February 28th, more than $54 billion in direct losses, and counting. The broader economic damage is measured in the trillions. For decades, the world was warned. Every analyst, every strategist, every energy economist. The Strait of Hormuz is the world's most dangerous choke point. If it closes, the consequences will be global, immediate, and severe. They were right. The strait is closed. The consequences are here. And the bill is still being written. We cover the infrastructure the world depends on, and the cost of getting it wrong. every week on the channel.